Have you ever wondered how to get more out of your business without sacrificing things like your own time or your employees or the benefits that you're providing to your customers? If you're like a lot of business owners, finding more profit is very hard to do, but it doesn't have to be hard. There are some really great tricks that you can use and tools that will help you to calculate this without making even more headaches as you're running your business. So today I want to share the customer profit contribution method. It's developed by a guy named John Fenton, who wrote a fantastic book that's just chock full of ideas like this called How to Double Your Profits Within the Year. Here's what it looks like. It's no longer in print, but you can get a copy. If you can get a copy, I highly recommend it. I'm just going to show you an Excel spreadsheet that has the figures from his book spelled out. So what we're going to do here is just use an example company to show the average monthly purchase and the size of that customer's purchase. So we have categories of less than $100 per month, $101 to $500, $501 to $1,000, and $1,001 and up in monthly purchase per customer. So then we look at how many customers are a percentage of each of those purchases. So 35% of all customers are going to be purchasing at less than $100. 40% of customers, the majority, are purchasing $101 to $500 a month. 20% are buying up to $1,000, and then 5% of customers purchase $1,001 and up in products or services from this example company. So the next thing we do is look at the percentage contribution to total sales. So how many of these purchases are distributed among the total sales, the revenue. So 16% of customers' sales are less than $100 per purchase. 38% of our sales are coming from purchases of $101 to $500. 30% are coming from $501 to $1,000. So those two would make up the vast bulk of the total sales. And then 16% are for purchases of $1,001 and up per purchase. So you can see here that the majority of our customers, as a percentage of the customers, are purchasing $101 to $500 worth of average purchases, but the distribution for our total sales actually falls between these two categories, $101 to $500 and $501 to $1,000. But the real test is going to be where our profit is coming from. So profit is what's left over when you take the revenue or the total amount that you're selling and you take away the expenses or the cost to do the business itself, anything that you're spending money on to run the business. What's left over is profit, and you can use that to put back into the business. You can use it to distribute payment for yourself as the owner. You can use it to incentivize your employees. You can use it to keep it in the bank for a rainy day, to purchase more equipment. There are all sorts of things you can do with profit. But when you don't have profit, the business has less value, and you have less flexibility to keep it running as the years go by because expenses continue to go up, as we all know. So percentage contribution to total profit would be how much of the profit is coming from each of these purchase areas, these categories. So only 2% of purchases of less than $100 a month are part of the profit that is being retained by the business. 8% of the profit is coming from purchases of $101 to $500. And then look at this, 50% of the total profit for this business is coming from purchases of $501 to $1,000. And 40% are coming from purchases of $1,001 and up. So what this shows us, and back down here you can see that 100% is the total for the sum of these percentages, just to double check the numbers there. So what we can see from this really simple graph is that the vast majority of our profit is coming from these much larger purchases, which only make up 25% total of our customer base. And the contribution to total sales is only 46%. So this company most likely is spending a lot of effort trying to get these lower end sales and serving customers that the number of customers that purchase less per purchase is very high. So you're going to have a lot more time and effort selling to and retaining customers that will generate quite a lot less in profit rather than focusing on these much higher ticket items, which contribute to a much larger, in fact, the entire bulk of total profit is coming from those last two categories. So that's how we can look at the contribution toward profit from your customers. I hope this has been really helpful to you. If you want more ideas on how to evaluate profitability or how to improve the growth and value of your company, check out leconteconsulting.com.